another big piece of why we think the market is strong. 20 years ago, I got asked to speak at a high-yield debt conference here in Las Vegas. And the conference promoter is this guy. His name is Mitch Julis of Canyon Capital. So Mitch Julis, also known as one of the best value investors of the last 20 years, he's put normally at the top of any of these rankings that you see in Value Walk and Value Investor and elsewhere. I went up to Mitch, and I didn't really know who he was. And I said, Mitch, I don't know why I got asked to speak at a high-yield debt conference, because I'm kind of like an equities accounting guy. And he said, if you didn't know how you got asked to speak here, why did you accept? And I said, I'm in my 20s, I'm single, it's in Las Vegas, it was a free trip. It was a pretty easy decision. And I said, my answer was because I was nervous. I said, seriously? And he goes, your expertise is accounting. That's what the audience wants to hear. You don't have to know about credit default swaps or gammas and alphas and all these other crazy things. Just talk about the accounting, because equity and credit are both derivatives at the end of the day of the firm. So if you understand the firm, you can explain what you see. And at the time, we were talking about Amazon being a high cash flow generating company, not a negative earnings company. This is 20 years ago. This is 99. He said, and if people see that, they'll know what to do with the credit. They'll know how to figure out the rest. And so, some of the best advice I'd say I've ever gotten, and as Mitch has, I'd call him a mentor to me, because I keep going back to him over the years. He said, if you don't understand credit, you will be a bad equity investor. That was his comment. He said, and if you know credit, you will understand equity at a whole new level and in a whole new light than you've ever seen. And so I took that advice and I said, all right, I better pay attention, because I think 2 years ago, Mitch and Josh Friedman, this is a multi-billion-dollar fund. I think they own the firm 50-50. They split $300 million, and that was not their best year in terms of income to the owners. So incredibly successful by doing this. So another pop quiz. I'm going to show a list of market collapses of more than 40%. And all I want to ask is, which ones were preceded by a credit freeze 6 to 18 months before the market collapse, the leading indicator? So how about the market panic of 1907, which is on a newspaper headline in the hallway of Buffett's offices, where he says he wants to remember these things? All right. That was absolutely a credit crunch. That was a credit crisis. Financial contagion, that phrase, was all over the newspapers back in 1907, all right, 1908. Bailouts were occurring in 1907, 1908. The Great Depression, absolutely, that was a credit crisis. We know that. Preceding the market collapse. The Roosevelt recession, that was an interest hike. We've heard a lot about interest rate hikes. That was an interest rate hike-driven market collapse, equity market collapse. The credit crunch of 1970 is actually what they call the equity market collapse, which is clearly, New York City almost went bankrupt that year. They had to get bailed out. The Latam Crisis, this is global. In fact, every developed market, if you see a market collapse, a stock market collapse of 40%, you will see a credit crisis precede it that for some reason the equity investors are not paying attention to, while Mitch Julis has been for these last 20, 30 years. This is the Asia financial crisis in 97, 98. The dot-com, the tech bubble, was a financing bubble. You would not have had stock prices go that high if you didn't have such easy money in private placements going in. In 99, the private placement markets dried up completely. The bond markets and the debt markets dried up completely in 99, a good 6 to 8 months before the market collapse come April 2000. And finally, of course, we know the Great Recession was. I would suggest to you that every big equity market collapse has been credit-driven. We've got to be good credit analysts if we want to be good equity investors. And so, if Wall Street and the three credit agencies rely on generally accepted accounting principles, meaning they're reporting earnings as reported, they're forecasting that same garbage number that we've just shown all day long, right? I've read personally hundreds and hundreds of S&P, Moody's, and credit and Fitch corporate credit ratings. They're not making these adjustments that we talk about. Yes, they use EBITDA, so that's earnings before interest, taxes, depreciation, everything. That's 4 of the 100+ adjustments that are necessary. And I'd argue 2 of them aren't even the right 4 of those. But it looks like they're doing something. This is not Dr. Evil. This is Marty Whitman. Marty Whitman is one of the best bond investors of the last few decades. And his comment, when he says what Wall Street does doesn't reflect the value of the business. He was talking about the fact that they all talk about earnings per share. He said, everything's about earnings per share, and if earnings per share is meaningless, what the heck is the use of hearing this Wall Street research? Jim Chanos, one of the top short stock pickers of recent times. If the rating agencies are so late in telling us what's really going to blow up, what good are they? Well, it hasn't changed. I don't know if you've read any corporate credit rating reports. They're not that different than they were in 2007. It's still based on cash from operations, big problem, an EBITDA calculation, big problem, and other things. So what we built was a corporate credit default index because we didn't want to take what was coming out of Wall Street and the big three credit agencies. This is, all right, investment grade, that's the blue. High yield companies, that's the default score. And then crossover just means in between. So when you look at this, that's what happened. That started kicking in 2007. It tripled from December 2006 to February of 2008. So the market may have been down 5-10%, maybe 15% even, but you still had another 9 months of avoiding the losses by realizing that this was yet another credit freeze, just like the last 10, 15 that we could go through, going back over 150 years. We could go back even to the railroad booms in the 1800s, and you see easy financing, driving those stocks up, credit tightening, and the collapse comes in. As this collapsed, we had one of the best buying opportunities for a bear market rally, and then 2012 came along, 2011. This was a really tough time because corporate profits were rising, but it looked like another credit freeze was coming in. Honestly, we didn't know what to do. We said the signals just aren't there. That was a tough year to make a call. Since then, our very vocal calls have been buy the dips, dollar cost average into the S&P for the last several years, and there's nothing saying you should stop. So in line with what Sugarroot had said, there's nothing saying. We'd go so far as to say, based on credit research and the credit analysis, you don't really see a scare until 2021. So we'd push it out another year further than I think Sugarroot was saying in terms of how long we're going to see this incredible bull market. So when he says we're not yet there in terms of really seeing the silly season of PEs of 25 going to PEs of 35, we would totally agree. A different point of view from where he's coming from, but the credit markets would back that up. If we're to change our mind, we'll know it. You'll see it. You will start to see credit break down a good 8 to 18 months before the next S&P crash. You will. That really supports this on why it's a buy the dips market. The credit supports this.